We've got a small group today. This is the first of DealPoint's On Point webinar series, where we hope to bring interesting content primarily about alternative investing, both in asset-backed investing and venture investing. So stay tuned for other notices that will be coming out of the DealPoint team. For those that don't know me, I'm Sandy Gilbert. I founded DealPoint quite some time ago in the second iteration of where the platform is. We license our platform to broker dealers as a SaaS technology, and we have DealPoint Plus that offers services and the software for venture funds, special purpose vehicle investment vehicles, and some fund administration. So welcome today. I've got with me DealPoint team, Solène. She's in my top right corner. I'm not sure where she is for you, but she's actually literally in France. So thanks for jumping on. Solène really manages all of our onboarding and our client success, so has direct contact with our clients. And Marcy Jones has joined the DealPoint team just at the end of last year as our head of growth, as we're getting some trajectory and capturing some market share, both in the traditional SaaS model, but also on the services side. So thanks, team, for being here as well. And today we're going to have a conversation about MICs, mortgage investment corporations, and alternative mortgages. And today we're happy to have with us Dean Koeller from Calvert Home Mortgage. Dean and I know each other well from not only the mortgage space, but we're also very active in the innovation sector here. Dean's on the board of Platform, and my hat on the Intergen side. We run across each other a lot, trying to ensure that entrepreneurs have the capital they need to grow. So thanks for being here, Dean.
Thank you.
And I've got Josh Higgelke. How did that do? Pretty good?
You excellent. Nailed it.
All right. Thank you very much. And Josh is from Mortgage Connection, who is a mortgage broker for alternative mortgages and works closely with Dean in this sector. So the first thing I'm going to do is ask each of my guests to do a brief introduction on who they are, what they do, and why you might be here today. Dean, let's go.
Perfect. Thank you. So I've been in the business almost 27 years. My father started Calvert Home Mortgage in 1975, and really very early on in his business career identified that there was a really big gap between what the banks and trust companies were willing and able to provide, and there is some time differences as to how quickly mortgage transactions could be created. So that was his business career. I joined him in 1997, and that's really where we started to innovate the product in a number of different ways. My brother joined the business in 2003. My father retired out of the business in 2015, and we've continued to grow and expand. Today, we have over 50 employees. We're operating all throughout the Alberta and Ontario real estate market. We're the only mortgage company in Canada that brings all of the key stakeholders services inside. So we have our own appraisal team. We have our own legal funding team that allows us to produce mortgage transactions in Alberta in 24 hours and in Ontario in 48 hours. And that type of turnaround has a real big need in the marketplace. And I'm sure Josh will talk a little bit more about some of those services that we provide in the market. As Sandy indicated, we're also heavily involved in Platform. We see the evolution of the real estate industry as being ripe for disruption. We've essentially been producing mortgage security transactions the same for the last 50 years. So we see that there's a lot of opportunity. So how can fintech, prop tech, and other technologies enable our business to improve? So we have a stated goal that we want to get from mortgage approvals from being 24 hours down to 2 hours in the next 5 years. And then after 2 hours, we want to get it down to 2 minutes. So how can we use AI, machine learning, algorithms and systems and processes to continue to innovate, to meet the customer's needs on a more timely fashion?
Well, that's fantastic, Dean. As we always say, technology isn't an industry, Every company needs to look at how they can incorporate advanced technologies into their business to be more efficient, attract more customers, more investors, and be more efficient at what you do. So good news. I know you've always been forward thinking in that way, and your business is one that can really have a lot of technology support because there's a lot of paper and a lot of time involved, right?
Yeah.
Right on. Josh, I'm going to just move to you here for a second. You use Dean, I think, to help your customers who are looking for alternative mortgages. So why don't you just give us a bit of a background on you and what your business does?
Yeah, that's correct. So I became a mortgage broker in 2007. In May of 2018, myself and two partners started our own brokerage called Mortgage Connection, which is about 140 licensed brokers today, primarily in Alberta with a handful in Ontario, which works well with Dean's business model. So we've worked well together there. We specialize in residential and do some commercial lending. But typically that's standard. The business started looking for standard A-type lending, like going against the banks. But as we grow and as rule changes continue to take effect in Canada, and it becomes harder and harder for a person, an applicant, to get a mortgage, I find there's more and more opportunity for alternative lending, like what Dean and Calvert offer. And so, yeah, it's been a pretty great relationship. It's nice to have them as an option for our clients.
That's awesome. Dean, you're heavily involved. I think you may have actually founded the association around MIX in Canada. Can you tell us a little bit about the structure of your investment vehicle? It actually is a mortgage investment corporation. It's got some governing regulation, but it's not like a GP-LP structure that we would have in the venture space. Can you kind of talk a little bit about the mortgage investment corporation instrument?
Sure, yeah. So the instrument was actually created out of the Income Tax Act in the late 60s. And with the influx of baby boomers coming into the residential real estate market, the government was looking for mechanisms that they could use to entice more capital into the mortgage industry. So that it was really generated as a vehicle to bring more capital in. So we have a number of rules that we need to follow. All of our assets need to be in Canada. 50% of our assets need to be in residential mortgages. No one party can own more than 25% of an entity. And there's a few other rules, like we can't develop property and other sorts of things, that really allows us to collect capital, be able to collect that capital through registered accounts, TFSAs, RSPs, RESPs, and avoid any tax implications. So we're not taxed as a corporate entity. All of the interest income that's generated is taxed in the hands of our shareholders. And if they have those investments in their registered accounts, then there's no tax implication. What's remarkable about that is being able to avoid the tax implications, to your retirement. You're able to really take advantage of the compounding interest effect. And if you can generate somewhere between, our industry is doing on average between a 6 and 11% return. You can do a 10% return, you're doubling your investment every 5 years, which is a wonderful investment vehicle to take advantage of with the right type of investment.
That's awesome. Dean, I had a cocktail with a colleague of mine the other day that told me he just moved a chunk of cash into your MIC through his registered plan, and he's pretty excited about that, which kind of leads me to how many people actually know about this? Because for Doug, he just went, I didn't even know that this was available, and I've been in the markets, and I looked at my last 10 years in the markets, and it wasn't looking too good. How do you reach out to people to share the story about this opportunity as an asset class for part of your investment portfolio?
Yeah, that's a great question. I would say our industry has a number of different models. Some use third-party exempt market dealers to attract investment. Others use IROC dealerships to bring in capital. For ourselves, we focus on high net worth families and family offices. So we're looking for long-term, more multi-generational type of capital. But most of our investment relationships are created from a referral source. So
Right.
someone that's had an experience of working with us and is interested in looking into our type of product. So yeah, there's lots of different ways to get introduced. In prior to 2010, which 2010 was the year that our industry became regulated by the Securities Commission, it was a very private type of transaction and activity that occurred. Since 2010, our industry has gone from 0.02% of the entire real estate market to now we're just under 2% of the entire mortgage origination of the real estate industry. So there's been a massive growth, which has really helped to profile our types of investments a lot more. One of the challenges that we have is, with a mutual fund where the banks are get some level of fees associated with it. A lot of the banks don't want to put our types of products on their shelves because there's no way for them to monetize a fee structure that they can get a portion of what the fund is doing.
Right.
So that creates a lot of limits in where shares can be held in accounts. And I'd say a lot of our shareholders have difficulties holding those through financial institutions.
Yeah, not unlike the venture space, right? They don't want to hold that paper. And then, from a private wealth manager standpoint, you're taking it off book with them, and that doesn't work out very well. So it really is an area that I think we need to really educate those private wealth managers that, part of that portfolio can go this way, which will benefit your other portfolio too. So really, the more they can know about it and really understand that it's an addition to or an and to, not an either or, I think that can definitely help. And before I leave there, you do not have to be an accredited investor to invest in a mortgage investment corporation, because some are using the offering memorandum to allow for retail investors. Is that correct, Dean?
Yep, there are some operators. We don't do an offering memorandum, so we just do friends, family, and accredited investors. But we do have a number of players in the marketplace that are doing offering memorandums and give that ability to the eligible investor.
Yeah, so it's nice to put some of it into your registered plan accounts, whether that's TSFA or RSP, obviously. So we've talked a little bit about what the instrument is and how people invest in it. Josh, who uses this product? Who are the people that are looking for alternative loans that you can facilitate from a fund mortgage investment corp like Dean's?
Yeah, that's an interesting question. I've talked about Dean's investment vehicle with a number of potential investors, and I've referred friends and family to them. And that's always the question they ask me. Well, who's borrowing this money?
Mm-hmm.
Right? Like, is it safe? Is it secure? And so I've had to go through it. And we've had AAA applicants who would be qualified at any bank, who will sometimes go to the MIC to use the funds, because often it's maybe a faster turnaround than a bank can facilitate in order to transact. We have it sometimes where people might have damaged credit, but they have a lot of equity, and just using the MIC as a stepping stone to maybe help pay out some debt, improve credit, and then pay out the MIC with some A financing after. I know that they specialize in flips, and I've done a lot with Calvert Home Mortgage and their flip program. Your standard banks don't like flippers. They're not designed to be profitable on their mortgages with a flipper who's going to buy the property, fix it up, and sell it within 3 months. They really strongly dislike them. And I know
it costs them more money to administer that loan than it does to actually generate it, or the interest you get out of it, right?
Yeah, I've heard from a lot of them, like they really base their profit on the second term.
Yeah.
Right? They're looking for clients to renew. And I think they have like 88% renewal rate. So they've built their model around that renewal. And if someone's taking a 5-year variable and closing it out in 3 months, they're losing money. So they're not fans of it. Where Calvert has built a program that's beautiful for flippers. Once they get their head around the fees, it's more the availability of the funds and not so much the cost. And then even just property types. I've had clients where they're buying maybe a foreclosure that needs a little love, and the banks don't want to loan on it because that's their security, the asset, where Calvert will look at it from a different lens, see that the client has the wherewithal to fix it up, the funds available and the knowledge, and it's similar to a flip, and they'll take that project on. So always with of course, the security being the real estate, but there's always a good exit plan in place.
Exactly. Yeah. And Josh, you provide loans to all sorts of people. You would broker it with a financial institution like a bank as well. Is that correct with your clientele?
Absolutely. And I feel I have a good understanding what they're looking for. So when we approach Calvert with a loan, we know they want the exit plan. And often the exit plan is that if we do this, they'll be prepared for an A type mortgage after, a traditional type mortgage. Yeah.
Right. And Dean, you're a pool of funds, so you're not doing a mortgage to an individual. You are a pool of funds, and that your fund is then funding any number of investments.
Yeah, that's correct. So, just as an example, today we have 813 mortgages representing $287 million. And our average interest rate is 11.46. And our average loan to value, and loan to value is for based on what the property is worth, how much have
Yeah.
we lent against it? And that's at 58%. So
Wow.
it's exceptionally low loan to value, which lowers the risk. And what's the other thing that I find really interesting is, and Josh, correct me if I'm wrong, I think a bankable client has about a 650 or above credit score. That still be about right?
Even 650 is tough now, Dean. They've really cracked down on it, but yeah, minimum 650, it seems.
Yeah, and we got over 76% of our clients that have a beacon score of above 650.
Right.
And a
So it's not
decade ago,
necessarily about, it's not about the type of credit. It's about the need for that credit, really. Is that a fair way to say it, Dean?
yeah, that would be a
Yeah.
good way to put it. And time is typically a transaction of how quickly can you make a decision. So we know we have the financing in place. If you bought a house and you sold a house, the dates might not match up. You need to borrow equity from one property to the next. So, we have transactions that last days. We have transactions that last months. On average, we're turning over our whole portfolio, call it on an average 300 million, 120%. So we turn a whole book over more than once a year, whereas I'd say the industry average is closer to 30% turnover on an annual basis. So
Right.
we're much more liquid than a traditional fund in our space. And then you compare that with the banks. Josh, I think it's their turnover is around 13-14% in the banking industry, right?
I believe so. Yeah.
Yeah.
Yeah. So, I mean, you started out, Dean, by saying that you brought a lot of the professional services that are required to actually execute a mortgage in-house, which I'm sure means a lot to your ability to turn it around and managing the costs of actually executing on that mortgage. Fair?
Yeah, absolutely. And the other benefit of having an appraiser in-house, like every morning we prioritize what mortgages need to get valued or what properties need to get valued more quickly. But on the other end, we can look at if they're going to do $20,000 of renovation, what's the after repaired value? And I would say a traditional appraiser is not very good at making those types of estimates. But because we do so much of that type of transaction, we have experts that know and can help real estate investors say, look, you should be spending about $28,000 on this and this and this, and you'll maximize your sale price. So they're not only coming to us for the financial capital, but they're coming for the advice on how do we make the best real estate investment decision so that they're maximizing their profits. And we're protecting our investment as well. It doesn't serve us if we're lending money to a client that isn't going to be successful in their transaction, whether it's getting to a bank financing or whether it's exiting the property and making a certain amount of profit that they're looking to do. And that's really where we partner with our mortgage brokers to help us work on what does the client need to do and how do we ensure that we've given them all of the tools and resources to be successful in that transaction.
And you must have a lot of repeat mortgages. Like, do you have the same client doing multiple mortgages, Dean?
Yeah. So there's a few ways that we would break up our client list. Or 75% of all of our transactions come through trusted advisors like Josh as a mortgage broker. And then the clients that are actually lending money from us, we have key accounts, which means they're doing more than $2 million of real estate financing with us annually. And we have close to 17% of our clients in that repeat where they're doing more than $2 million of real estate transactions annually.
Gotcha. So let's go back to the investors for a second. We've been talking about who might use the product. The typical investor that you have obviously is an accredited investor. You're dealing a lot with family offices and kind of long-term portfolio strategies. How long is this investment? Are you in for life, or how do I get my money out? How does it work from an investor standpoint?
Yeah. So in our business, we do annual distributions of all of the income that's generated in the fund. And going back to the MIC rules, we're required to distribute all of the income that we earn on an annual basis. We can't retain any income. So it's mandatory to have all that income into the investor's hands on an annual basis. And we allow for an annual redemption. So any investor that wants to redeem on an annual basis at our year end, they notify us how much they want to redeem, and we'll redeem up to 10% of the equity of the firm.
Right. So it's a liquid, but it has a redemption factor to it.
Correct.
But I mean, I would say many of your investors are probably in it for the distributions anyway. Is that fair to say?
So as we just finished our distribution on May 10th, and we had 50% of our investors reinvest their dividends back into the new shares in the company. And we had 50% that went out into distribution. So on an $18 million distribution, we had 9 leaving in cash and 9 that was reinvested. So, we've got a really good balance of later timeframe investors that are just looking for that capital to fund their lifestyle.
Yeah.
And then the other half that are looking for, how am I using this as a vehicle to grow my wealth over time?
Right. And when you do that DRIP, that dividend reinvestment, how is that taxed? If I'm in my registered plan, I can just put it right back into my registered plan, correct?
Yeah, with no tax implications. If it's outside of your registered accounts, interest income is taxed at the highest tax bracket. And so you don't get the capital gains exemption and traditional dividend types of tax implications. So it is something that you need to be thoughtful that outside of a registered account, that you've got the right investment vehicle to be able to absorb some of those tax implications.
Yeah, and typically that would be that you're not, taking down a big salary yourself, so it's, puts you in a different income tax bracket, right?
Yeah.
Yeah, gotcha. So, we can't have this conversation about taxes before we leave the capital gains situation that is out there right now. I just came back from Ottawa, so I said we were in the Lion's Den last week talking about some of these implications, but you would have capital gains implications, I would suppose, on a redemption. Is that when your investors might see capital gains?
There's very little opportunities for our industry to create a situation where you have capital gains.
Okay.
So when you're lending a security as a mortgage, the mortgage is going to be worth what it's worth. So there's very little opportunity for any type of capital gain that can be created out of that situation.
Right.
What you're more likely to see is capital losses. So on average, over the last kind of 44 years that we've been tracking our loss ratio, you lend $100, the likelihood that we're going to lose, on average, we're losing 36 cents.
Okay.
So we're charging a 10% interest rate. We're going to lose 36 cents on that transaction. Most of that is absorbed through the distribution,
Right.
but there could be a portion of that if the capital loss goes to the mortgage, where that reduces your net asset value.
Right.
So over a 5-year basis, we've seen less than 10-cent drop in our capital stock value.
Right. Gotcha. Okay. Makes sense. Whereas when we're sitting in the venture space, these are kind of long-term holds, no distributions coming for many, many years. And then you ultimately have the exit that you hoped for that will hit you with that capital gain. So hence a lot of that conversation there for sure. Joss, let's go back to you for a second. How do people find you as a mortgage broker? I mean, I think there's a lot of people that think the only place they can get a mortgage is at a bank. And, there's a wealth of intelligence and smart people like you running businesses that can find the best product for the client. What types of clients do you see, and why do they come to you?
A lot of my business started with realtor referrals. I hit the ground running, and I wanted to get out to as many realtors as possible. I find that in a purchase transaction, they tend to be the quarterback, right?
Yes.
And so when they refer someone out, that's someone that typically the clients will at least give a chance to. And in that way, the realtor knows if they've got a good partner, they're able to keep track of the deal, know where it's at, work together as a team. Sometimes when it goes to the bank, it just goes into the abyss and they hope that it closes, right? And so
Right.
over time, though, again, 16 years of being at this, after time, it just starts to snowball. I've got a lot of repeat clients and friend referrals and still a really great network of referral sources. But that book just starts to turn over, and my friends at Calvert will refer the odd client my way if they don't fit Calvert's box. And yeah, just again, word of mouth and getting out there, networking.
Yeah.
Mhm.
And what would I expect if I were coming to you to say, I've got this house I want to buy, I'm going to do some work on it and sell it. What's the process look like with you, Josh, for me to come to you and say, I need a mortgage?
You need more. If we're starting right from scratch, we'll start with an application. The application process is about 5 to 10 minutes. We get the initial information. My team and I go through everything, dot the I's, cross the T's. We always come back with a few questions and really refine that application and what the client's needs are. From there, we'll provide a list of documents, supporting documentation like income docs, job letters, pay stubs, maybe T1 generals or corporate financials, depending on their self-employed or employed. And we go through everything with a fine-tooth comb and then really find where that client fits. Are they a standard type lending client and we're focused on maybe a 3-year fixed mortgage, which seems to be very popular right now? Are they looking for a flip? And if that's the case, then in comes Dean and his team. And so from there, then we get them pre-approved or get them set up for that purchase, and then we move forward.
And how have interest rates affected your business? I mean, we've been in this we all know that we've got a shortage of housing here. We've heard the stories of people being outbid on properties they're trying to acquire. What has the rise in interest rates meant for you? And before I let you say that, I chuckle every once in a while about interest rates because, my first car loan was at 22%. So I remember interest rates, but for all these people that grew up with 0% interest rates, they're in a panic right now. But how has that affected you?
Yeah, it's funny you say that. Like my first mortgage, I was in my early 20s, was 574.
Yeah.
And then from there, they just went straight down. I was like the mechanic who didn't have a car that was running. I was in a worse mortgage than I was getting everybody else at the time. But we were really spoiled in those 2% and sub 2% 5-year fixed mortgages, those artificial interest rates that we had to stimulate the economy. And I think people grew a little more accustomed to them than maybe they should have. It certainly hasn't slowed down the desire for people to purchase. So with the shortage of housing in Calgary, that's where my primary business is, we've seen such a shortage and such a demand with all the immigration and migration that it seems to have really fueled that market. I think the biggest thing that's affected us is our clients are, in the height of COVID, when everybody was buying, they weren't shopping the mortgage as hard. And what I mean by that is people are more, because the rates are so high, they're really pressing to try to find the best rate possible. And it matters. It matters more so now than before, right? So we just find that we're revisiting rates more often than we were, trying to stay on top of it. If there's any movement in rate, we're trying to secure the lower rate for them. So it's just, you're really refining it more so than before.
Yeah, maybe even a bit more need for what you do today, right?
Yeah, and I would just also add, the benefit of having an independent mortgage broker is that they can really look at what's the best product for you.
Right.
And, no offense to the banks, but the banks are fairly motivated by, what their products offerings are, and they like to sell what they have as opposed to, someone like Josh and his team, they work very diligently to make sure that they find the right product, solve the right problem, and then get the client to the long-term solution that they need. And that's so beneficial for everybody. And then having a professional that knows how to educate someone through the whole transaction so that they're not missing anything. Because there's always little things that get missed through the process. And you have a lot of experts that are involved in a real estate transaction.
Yeah.
And having a quarterback like a mortgage broker that understands all of the actors and who's good and who's not, I think is so valuable in just having that peace of mind that you have a professional working on your behalf.
Exactly. Yeah. Very, very well said, Dean. Let's talk a little bit, Josh, you mentioned the newcomers and the immigration push and the, kind of the lack of housing that we have here. From a big picture view, Dean, what are you seeing out there with this crazy real estate I don't know what you call it right now, but it's, we obviously don't have enough houses, but secondly, we seem to be investing a lot in that real estate today. What's it looking like out there, this real estate market over the next 10 years? Where's your crystal ball, Dean?
I was hoping Josh would jump in first before I kind of did mine. I think the media has finally caught on that there is a housing crisis. This is something that our industry has been talking about for over 8 years, but it just hasn't been media worthy. Whereas finally we're getting the attention to it, and we're getting political attention as well. Some of that is on brand, and some of that I think is a little bit of smoke and mirrors. But we do need to be very thoughtful as an industry on how we're addressing these problems to ensure that we're meeting the needs and desires of clients and providing the right type of products that the market needs to have. The reality is we need to double the housing stock on an annual basis than what we're currently creating. And we have so many limitations that it's just not going to be achievable in any near-term aspects to be able to address. So we're going to continue to see supply demand issues driving, and that's going to shift, a lot of behaviors. I would say, Alberta has seen a massive increase in immigration and migration, and affordability has been one of those issues. You can't find, for new immigrants, you just can't find housing in Toronto, Montreal, and Vancouver. So they're going to need to expand their search, and Alberta's been a great benefit of that over the last little while, and I think that's going to continue just based on our price point compared to those other markets. So I think we're going to see a lot of shifts, and we're going to see a lot of changes in how we perceive and utilize real estate in more effective ways.
Well, and even, Dean, in the types of mortgages, like your alternative mortgage product, can help somebody kind of get that first step into a house, and then get into different banking arrangements after that. Is the newcomer population something that your industry can focus on, or is it just too hard when what I call they're not banked, right? It's not that they don't have good credit, it's just they don't have the credit here, right?
I'd be interested in Josh's opinion on that.
Yeah, Josh, can you jump in?
On newcomers to Canada?
Yeah.
So yeah, there's really what we need here is for them to have been here for about a year's time.
Okay.
Once they're here for 1 year's time, we have programs in place where they can buy with minimum down. It's actually called New to Canada program. And so we can use things like bank statements, utility bills to help establish that credit. And really, we would treat them like anyone who's been here their entire life. So if they have 12 months of bank statements to verify rent has been paid on time, and maybe 12 months of a cell phone plan, they'll treat them like top credit score applicants and allow them to come in with that minimum down payment threshold at regular CMHC or SAGEN or Canada Guarantee mortgage insurance premiums. So it's really the same playing field as long as they've been here for 1 year's time.
Right. So it's just key for them to understand that that's what they need in order to get their foot in the door into the real estate market. And Dean, back to you, it's a lot easier to do that with the average housing price in Calgary than it is in Toronto and Vancouver, that's for sure.
Yeah, absolutely. And then starting to look at where can we leverage densification? Like in the city of Toronto now, you can develop up to a fourplex on any single family resident. So we have, real estate investors that are building laneway housing on top of their garages. They're doing basement suites and other sorts of things that's creating densification and allowing affordability in the rental market. That's going to allow these new immigrants and future home purchasers to be able to afford the rent and then be able to save for eventually purchasing a home.
Can I make a comment on something, Dean?
Yeah.
You had mentioned earlier, and I found it very interesting. It's kind of, I go back to the height of COVID again, that 2021 era where housing went crazy. When COVID first became a reality, I thought, oh, it's over for me. Who's going to be buying houses if they're locked in their homes? Like, hey, Dad, I'm moving into your basement with my family. And then the opposite was true. And it was in that time when you started to see people moving to Calgary. And typically, I'm originally from Northern Ontario. I moved to Calgary, but I found people born and raised in Calgary would move to either Toronto or Vancouver. They seem to move to the bigger city. And so in that 2021 timeframe, I'm getting calls from Vancouver numbers and Toronto, and It's like, oh, hi. And out of curiosity, I got to ask, why Calgary? And it wasn't just your first time buyer, which we saw a lot of those. And people are still a lot of first time buyers. And their exact words are, I'm worried that if I don't come to Calgary and buy, I'll never afford a home in a major city in Canada. But you also have people now who are kind of, I guess you could say, cashing out. They're selling the condo for 700,000. They were coming here buying the detached home for less, putting all kinds of money in the bank. And I remember this one guy just kept saying to me, Josh, I get a bonus room.
Yeah.
He's got a house with the bonus room above the garage and trading in the 2-bedroom condo. And see, you're seeing both sides of the equation. Again, the first time buyer who is worried that they can't afford, or also the person just said, you know what, maybe my spouse can work remotely still. I can get new employment in Alberta. And yeah, let's trade in that condo in the big city for, well, the larger center anyway,
Yeah.
for the detached home in Calgary. And you're seeing a lot of that too. It's interesting this time around. Our last boom, what, 2016, would you say? And here we are now. Back then it was really, I would say, oil and gas driven. Correct me if I'm wrong, Dean.
Yep.
Where this
Yep.
time it's quality of life driven, it seems. Oil and gas isn't the same for anyone off the street today to get a job like it was back then, but people are coming here for housing. They like the location to the mountains and just the kind of the smaller scale that Calgary is in comparison to the GTA and GVA. So it's a really interesting trend that we're seeing this go around. And yeah, I wonder where it stops and what would slow it down.
Yeah.
Yeah,
You
and
know,
what's interesting is you look at the other big cities, and they all have space constraints it's forcing the prices to go up. There's nowhere for Toronto to expand. There's nowhere for Vancouver to
yeah.
expand. There's nowhere for Toronto to expand. Calgary only has, one quadrant of limitation in our growth. We can continue to expand, and we actually have more square footage in Calgary than New York City. And that can just continue to sprawl, which has some challenges to it, but it also allows for a pricing differential that we're never going to see pricing in Calgary like we see pricing in Toronto because of the availability of land that we have in our market in both Calgary and Edmonton.
And Dean, you look at the work from home concept of remote work now, it's impossible for, a couple who live in an 800 square foot condo to actually work out of their house because they are at either ends of a dining room table and are you on the Zoom call? Are you on the Zoom call? And so they know they need to create a bigger space to live in order to accommodate that luxury of being able to work from home. And I think we've seen a lot of that drive here in Calgary. I went by a new condo development the other day that is literally called Work Live Properties or something like that, right? So they're actually building homes and building condos with the concept of having a home office, which used to kind of be the place that you could work if you wanted to after hours, but now it's what you're doing every day, right?
Yeah, well, and that's the dream, is to be able to live in Alberta and then still have your job in Toronto, and get the wages and the salaries and the opportunities that you have in the Toronto market, but not have to sacrifice the quality of your life or 2-hour commutes in order to enjoy that lifestyle.
Yeah, that's definitely definitely for sure. So, Dean, let's talk about the future for you. You've been, this is a family second generation business that you're in right now. You've grown the business substantially since you and your brother came in. What does it look like in the future? How much AUM do you think you're going to have in the next few years? What does it look like for Calvert?
Yeah, so our plan is to grow at about 100 million in new originations compared to the previous year. There we have competitors that are growing a lot faster and quicker to that. We're staying very true to our roots and our focus as an organization, and really looking at the quality of the transaction and ensuring that we're not compromising risk and return as part of that analysis. But there's a tremendous amount of opportunity. There's 1.5 million homes in Alberta. There's 5.7 million homes in Ontario and 1.8 million homes in BC. Those three jurisdictions alone, we can very easily see ourselves growing to over $1 billion of origination annually in those three markets. So there's a lot of opportunity to growth. It's just about being smart with it. And then how do we start utilizing technology to increase the likelihood of success in a mortgage transaction while not increasing the risk? And it's very interesting. Harvard's been doing a study for a number of years now on mortgage originators out of the United States. And there's a 70% bias in how underwriter A and underwriter B make a decision as to what mortgage they'll approve. And this is where technology is going to be the best equalizer in taking all of that bias out of a mortgage transaction. In the banking system, there's about 14 data points that they'll utilize to decide whether it's a yes, no for approving a mortgage. We've tracked over 250 data points that we could look at in how we make a mortgage decision. So if we can start to identify better mechanisms to identify, what does a good transaction look like and what does a successful transaction look like, I think we can have the opportunity to help more Canadians than ever before and solve the problem and get them back into the banking system as quickly as possible.
It's funny you mentioned that bias because, there's some people that think that AI is going to add more bias into things, whether that's HR recruiting. And, I say to people all the time, so you don't think there's any bias around the table that's making that decision today? Certainly there is. And, any AI analysis, let's call it, needs to have some reasonability tests against it. But any business that wants to scale is going to use technology to do that, because you can't scale the way that you do business today. At least you can't do that rapidly. So I believe there's lots of opportunity in the finance, obviously legal, which your business touches on both of those, obviously, to come to the right decisions about what investments you should make. And you've got a lot of data now with the number of years that you've been running your business to actually make some difference when you can run some models against that, right?
Yeah, absolutely.
Good. And Josh, what's the future look like for what's happening at Mortgage Connection these days?
Well, I think the future is bright, as we were talking about with the demand in housing. This year we're seeing more transactions. Last year I found that that limit or the shortage was actually impeding the ability for people to actually buy homes. I think we're seeing a lot of condos and new development come online now, which is opening up some of that real estate. Like last year, we were renting a significant amount of pre-approvals,
Right.
equal to or more than ever before. But the pre-approval is just that. There's no deal attached to it if the applicants can't find a home to purchase, right?
Yeah.
So as we're seeing more developments come online, there's more real estate being opened up. We're seeing more, in our opinion, more transactions happening. And so I for the first time in a long time, the prairies, which is our primary focus, seems to be the shining star of the country again. And so we think we're in a good spot here with
Right.
our brokerage in Alberta. Yeah.
Awesome. Well, we have a few people that might want to pop a question in here. James, Don, Amen. Hi, Don. Anybody got some questions for our esteemed guests here today?
Yeah, I have a quick one. I was just curious. I mean, a big kind of topic in Calgary right now is this blanket rezoning issue. I'm sure you fellows are familiar with that. How do you guys foresee that? Like, what are you getting questions about that? And if so, if people are voicing concerns, how are you kind of answering them?
Go ahead, Dean. You touched on this.
Well, I'll go out on a limb. I'm absolutely in favor of the rezoning. I think that the economics, you rely on it, it's going to turn out for the benefit of the whole city. But it's very unnerving for a homeowner to recognize that the economic drivers are not going to create products in your neighborhood that aren't viable. So you have, communities like Mount Royal where they're worried about fourplexes and sixplexes being built in those types of communities. The economics to do that type of product in that neighborhood just fundamentally do not fit. But I understand and recognize how scary it is to give up the control that a lot of community associations and individual homeowners have in feeling like they have some ability to control what goes on in their neighborhood and being able to control that. But over the long term, we're going to do a disservice to the health of an entire community if we're not thinking more broadly about when there does need to be a shift in the economic value. And you look at communities where you're seeing a lot of redevelopment and densification. It's on places where you have larger lots and older homes, where the value of the home has reached its land value, that the house itself doesn't have any value. So the right decisions would get made by economics, but I recognize that that's very difficult thing to explain, especially for politicians to explain that value proposition. And I'm not confident that we'll be successful in making that transition in Calgary, but certainly doing investments in Toronto, I've seen the type of products that are being created and what we're financing, and it's right on brand with what the community should be looking at doing. But that transition's difficult. Josh,
Yeah,
what's
for
your
sure.
thoughts on
No,
that?
I share the same thoughts as you, Dean. I think we've seen it in other cities. It seems to be working well. I think you know, nobody wants that eightplex right behind them, but ultimately when you see development like that, it could increase your land value as well. Maybe not something you necessarily want, but for the greater of the city is my belief.
I
Thanks, Jess.
think from a, you know, we're obviously diving into a controversial subject here, but one thing that I think if people can think about is that kind of those main transit thoroughfares within those communities is where you could really take an advantage of multiple plexes on those kind of strips, right? We want to put them where there are transit for the people that are going to live there. You know, it's not necessarily going to be back in the bowels of the community, but when you're getting onto your transit routes, that's where it makes sense. And when I travel to other cities, whether that's London, England, or Toronto, those are where the economics make sense, right, for those things to happen. So, you know, I think that it's tough, and a lot of people in Calgary think that Calgary is the only city that's doing this, and of course, it has happened everywhere else. But it needs to be thoughtful and with some sort of you know, regulations or rules in place that are going to help it work.
Yeah, and
Don, go ahead.
oh, sorry, go ahead.
No, go ahead, Dean.
I was just going to say, from a lending perspective, we're quite hesitant to lend on homes on busy streets. They tend not to hold their value, especially
Right.
in soft markets. No one
Exactly.
wants to live on a busy street.
Yeah.
So why not create densification where you're putting product that the type of buyer isn't looking for that type of comparison compared to a single family home?
Exactly. Totally agree. Don, you looked like you had
Yeah, well, I had a thought, I guess. I don't want to get into this whole business about densification, if you will. I have my own personal opinions about it, but that's another thing. I did want to thank you, Dean, for your comments about mix. I tuned in today primarily because I wanted to see if things have changed, because I've been involved in several of them over the years. All of them went sideways, you know, where it was good until it wasn't. You know, all of a sudden they had too much money coming in, so they had to start giving mortgages out to people who didn't deserve mortgages. They defaulted on them. All of a sudden, you're down to a 2% return every year. Everybody wants out. You can't get out. So it was that snowball that rolled downhill, and I've still got 3 mix that we've been trying to get out of for 15 years, and we haven't been able to yet. So that's the downside of it. So you've kind of restored my faith a little bit, Dean, in terms of making sure that you've got the right discipline, if you will, to make sure that this all works. Because those other ones were not that successful. And I don't know whether that's
that sounds more like a venture portfolio, Don, not an asset-backed portfolio, right?
Well, no, there was two. There's several different products that we've tried, if you will, over the years. 2 of them were mixed from the same company, and they were the ones that got overextended in terms of their risk profile went way up, their loan to value went way up. We also did another one, which was it was a direct mortgage investment, so it was a pool of capital that was invested in individual mortgages. And again, that one was great until it wasn't. You know, when a downturn hits and the economy sours and all the values drop off, they can't sell them, etc. That one was mostly bridge financing, so it was 6 to 18 months kind of thing. Yeah. And we still have some residual there as well that we're waiting for that to cash out sometime down the road. But it's good to hear that if you've got the right process, discipline, that, you know, you can at least make a consistent return on it without having to worry about the downside risk.
Yeah, no, Don, those are great points. And usually my first question to any management team that's that's out there pitching is how much of your own capital or you have invested in your own fund. You know, our family, 6% of the fund is our family's wealth. So we're highly invested in the benefits and the success of the company. There are a lot of there's a lot of variety of funds out there that have a different strategy and a different purpose, and really interviewing them to make sure you understand that is really important. I would also highlight, you know, Josh talked about the 2006 high. If you look at a fund that's only operated in good investment periods, there's a bias that can be created that they think they're good at an underwriting when they're actually not, because it's the market that's allowed them to be successful. You know, for our business that's been operating for almost 50 years, we've been through 5 real estate downward transactions. So you can look at our results in the worst years to judge as to, you know, what should that perform, what performance expectations should I have based on what the organization does. The other thing is, you know, diversification. You know, we went to Ontario 3 years ago because I wasn't willing to sit with just Alberta assets in our portfolio. That wasn't a healthy diversification. So having Ontario has helped to diversify a little bit. Quite interesting that Ontario real estate had a 20% drop 2 years after we went to Ontario. But with that, we never exceeded our 0.36% average loss ratio. So even with such a large drop, we've been able to be resilient in that aspects. But you need to do your homework and talking to mortgage brokers, and that's why we have Josh on the call here. You know, where would Josh send his family member if they needed a mortgage transaction? And he sees the flavor of the types of transactions that get approved. Like we'll look at 100 transactions and approve 18 out of that. So we got an 18% approval ratio. So we're looking at a lot of transactions before we find the ones that fit our investors' profile. You know, and situations where you have a 70-80% approval ratio, there might not be enough due diligence to recognize a good transaction from a bad.
Right. Yeah. Good advice. Thanks, Dean.
I find it funny.
Thank you.
Sorry, if I may, like I've said I've referred a number of people and friends and family, and I'm invested with Calvert. And so when one of my brokers come, like, Calvert won't do this deal, there's a part of me that's like, yeah, like good. Go send it to someone else. Yeah,
exactly. Well, that's
I know I got some of those in my portfolio, by the way. The ones that Calvert didn't want, I got them.
Yeah, exactly.
Sorry, Don.
So listen, this has just been really great. What a fantastic discussion. I learned a lot. I thought I knew a lot about this business, but I learned a lot, and it's really just valuable to hear what you're doing, both from how investors can put this asset class as part of their portfolio, and how our individuals can build their businesses and get the money that they need to be successful in what they're doing in the real estate space. So thank you so much for that. As I said, it's a small team today. This is the first of our On Point webinar series that we intend to roll out to our community. So Dean, Josh, thanks for being the first today. We really appreciate it. And Marcy and Selene for helping get this off the ground. So stay tuned for more. And with that, I'm going to let you go and enjoy the rest of this afternoon if you're here in Calgary.
Thanks everyone.
Guys.
Thank you.